Hi everyone, welcome to Your Money, Your Call. I'm Nina May. Caller Darren from Queensland. Hi Darren, thanks for waiting on there.
Thanks, Nina. I'd just like to ask the panel about Ramsay Healthcare and about the growth prospects and if Roger's got a valuation.
Okay, Ramsay Healthcare is currently trading at $13.61 and RHC is the stock code.
I like companies that are growing their earnings rapidly. That's first prize. You just want to make sure that the business is also generating a high return on equity. The demographics for Ramsay are extraordinary. You know, the ageing, the baby boomers ageing. They're in a terrific space. You mentioned primary. Yeah. Now, there's a classic example of what I mentioned earlier in the program, and that is that, you know, when companies make overpriced acquisitions, you know, sometimes it can destroy the company for a long time. I haven't got a value. I'm guilty of not having a valuation with me today for Ramsay, but I can put it up on the blog and on the website, and I'm happy to do that. And I'll try and do it before I go away for the weekend, if that's all right with you, Nina. But let me say, the story is very good. If it doesn't have much debt and it's got a great return on equity and it's trading at a discount to its intrinsic value, and I don't know that it is at this stage, then, you know, it's a terrific opportunity.
It's not done. The car will be towed and the keys will be tossed away, Roger. There you go. More homework for you.
Thank you.
Yep, I'm tough. Straight to Robert from Morwell. Robert, good evening to you.
Thanks for your time. I bought Toll Holdings about a month ago and got caught with a $2 downturn with 10,000 shares, and I was wondering whether I should just take it on the nose and sell them or hang on. Time's not an issue. Thank you.
You got your sheet there for Toll?
I do have my sheets for Toll. They're my hymn sheets.
Yeah, sure.
The issue, you know, the sign that there were problems actually in the increase in the gross margin of Woolworths. Woolworths' gross margin went up, and that told you that, you know, hey, where did that come from? And it probably came from, you know, some very tough negotiating on the logistics side and the transport side, and that was probably, you know, that's probably what affected Toll.
Were you shocked when those Toll numbers came out, though?
Well, not really, because my value is substantially lower than even the current price. So I wasn't interested in buying it when it was at $8. I'm not interested in buying it at $7. So no, it didn't shock me. I'm interested in buying good businesses, but only when they're cheap. And in this case, this is a business that does have a good track record. I will say a couple of things though. My value for this particular business is going to really disappoint people. I'm a real Cassandra tonight, I know that. Yeah, but my value for this business is $4.80 this year. $5.
Ben's reaction over there.
I know.
Oh, I've heard it all before. You can't shop me anymore.
Yeah.
$4.80, $5.60 and $6.37 in 2012.
Cut 50% off share prices, Roger? Or
no, well, look, you know, I've made I'm embarrassed to say, you know, a nice amount of money by buying good businesses when they were cheap, but they're not cheap anymore. So I can't change that. It's not my fault that, you know, that people want to pay ridiculous prices for things. And I've said to you many times, I'm not able to predict what the price is going to do, but I can tell you what things are worth. And I think you'll do reasonably well investing if you buy good businesses when they're below their values. And right now, there just aren't a lot of things that are cheap. This is a business that generates a return on equity which is kind of okay. It's not bad. It's not outstanding. 12.7% this year, or 12% or thereabouts, 13% next year and 14% the year after, assuming things go reasonably well. One thing I will say, if there are some oil bulls out there and people who believe that the oil price is going to go up, well, you're probably a darn sight better owning trains than you are owning trucks. Because diesel goes up and it's much more efficient to transport things on trains than it is on the road. So that's my only big concern.
Just a general question, is there any value out there then at the moment? There's none that you can think of?
You could give me a rest for a few weeks and we could just wait and then get me back.
Yeah, come and see me next month. We'll see what we can do. Well, you know, a month's a long time on the share market, isn't it?
Look, there is one company, Telstra, I don't like as a company, and I wouldn't buy it. But it's trading at its value now. You know, finally, it's taken 10 years to get there, but there it is.
Love your disclaimers, though, Roger. Okay, Jeff from Armidale, our next caller. Jeff, thanks for waiting there.
Good evening. I'd just like to ask the panel about Macmillan Shakespeare, MMS, has a high return on capital, high return on equity, but has the Treasury's Henry report hanging over its head. What do they think?
Can I go first on that one, Nina?
Yes.
We've talked about Macmillan Shakespeare
and
here before.
And the Henry tax review, yeah.
This is a business that that is trading at a discount to its intrinsic value of about $4.10 or $4.20, and you're probably wondering, why didn't I mention that when you asked me, is there anything cheap? Because this particular business does have the dark, the dark cloud over it of the outcome of the Ken Henry tax review.
It's either going to go one way or another, isn't it?
If it's benign, then this is a great opportunity to buy the stock. But nobody really knows. Now, I owned shares in Macmillan Shakespeare, and I sold them when Podesta, the founding shareholder, sold $2 million shares, I think he sold, or $2 million worth late last year, and I think I sold at $3.97 or thereabouts, because it just didn't smell right. The founding shareholder selling a whole bunch of shares ahead of the outcome of the Ken Henry tax review. My experience as a fund manager tells me that's generally not a comfortable combination, and so I sold. Now I've got the luxury of standing aside and waiting to see what the outcome is going to be. And let me say this, if it's benign, the company's cheap. If it's not benign, the worst case scenario, Macmillan Shakespeare could lose half their business. I don't know what the outcome of the Ken Henry tax review is going to be, and once it's released, we don't know what recommendations the government's actually going to adopt. This is a company that actually provides salary packaging services to people who work in charities, and I can't imagine the government bringing out a whole bunch of legislation that's going to harm them. But we have to wait and see. I can't speculate.
Robert from Berwick is on the line. Hi, Robert.
Yeah, thanks, panel, and good evening, and thanks for taking my call. I'm new to the share market, and I'm slowly building up my portfolio. There's one I'm looking at the moment. Its code is SEK.
Okay, well, let's look at the graph, or the graph.
It's graph in Adelaide, isn't it?
It is
graph in
indeed.
Adelaide.
It is indeed.
The most profitable businesses on the internet, and you can look at them globally, are lists. Lists of cars, lists of houses, lists of jobs, they're lists. And they do really, really well. But in order to maintain that profitability, what you have to do is you have to create this environment, this competitive advantage, where you've got everyone. And so, as you rightly point out, people look for jobs there because there's a lot of jobs there. People place jobs there because there's a lot of people looking for jobs there. Unless Google comes along and says, well, we're going to do that for free, or we're going to knock that out and we're going to take over that market, they've got it stitched up. I don't know whether it's cheap because I haven't valued it for a while, but I can do that tomorrow.